Hello everyone, welcome to Blue Dragon Actuarial. Capital management will be the topic for today. And thanks for, there was around 70, more than 70 views for the ALSM video. Thanks for that. However, I do have one complaint. You guys are not liking the video, or although I can see the subscriber increase, but you are not like going and clicking on the like button, or you are not providing any feedback on the comment section. Someone wrote some feedback in Spanish language, and I don't understand what that person is writing. From the translation, I could make out that that person is probably writing something good. So please do like and provide feedback if you don't like something. That would help me to improve. And I mean, at least in the initial phase when I'm kind of starting this YouTube channel, that would help me to improve. Eventually, I want to grow to a big amount of subscriber base, and that I can only do if I'm able to cater to a large audience. So please, do provide feedback or do like, so that I know that you are liking what I'm producing and you are able to understand what I am explaining. So today's topic would be about capital management. So obviously, capital management is a very important part. What has been written here is that there are many agencies or many organizations which are kind of interested in the capital. First is the regulator. Regulator is interested in whether the company is going to be insolvent in few years or not. Basically, they're interested in the policyholder protection. Eventually, also the rating agencies are kind of interested. They're going to give some rating, AAA, BB, etc., so that the bond would be kind of priced on basis of that, and there would be a default risk associated. So it is not always sufficient to look at the available capital. The company has to project the solvency position to see that in future, near future, also the company has sufficient capital. Section 3 looks at various sources of capital and the available capital. This can be, shareholder capital. This can be subordinated debt. This can be financial reinsurance, etc. And also from the ongoing assessment of the ongoing perspective, various measures of the capital. And capital is also related to investment, which is the ALSM chapter that we have read, risk, and explaining why these are kind of intrinsically linked. That we are going to cover in section 4. Right, so moving on. Okay, so the capital position in a company is actually, so in an insurance company, there are two types of capital. One would be what we call available capital, and another which we call required capital. That is what kind of written here. And now, what is required capital? Required capital is where the capital that the company sets aside to meet its liabilities. It is the capital where the policyholder is more interested. Regulator is interested in whether they can satisfy the policyholders. Policyholders obligations, the liability basically. So that's why they are kind of interested in that. However, the shareholder is kind of interested in the best estimate capital, which is or to get a particular rating so that they can ride the business going forward. So that's why at least in Indian scenario, there are two types of reporting that you must have heard about. One is the statutory reporting, one is the shareholder reporting. Shareholder reporting in Indian scenario would be the VNB and embedded value. And the statutory reporting would be what we do to IRDA, the reports that we send to IRDA. So basically, if an insurance company, suppose at the start, the shareholder puts in some capital, it gets some premium. So suppose it has a overall total asset of say 200 rupees, and the liability is 100 rupees, right? So the liability would be like carried forward by like the prospective valuation of the reserve. That would be the liabilities. Now 100 minus 200, right? Sorry, 200 minus 100, that would be the capital, and that is what we call available capital, out of which a portion would be required capital. Right? How we determine the required capital depends. So in several regime, we have seen the use of risk-based capital. In fact, India is also moving towards that. But currently in India, we have factor-based capital. So which is that you take a percentage of the sum at risk and percentage of the reserve, but it varies by line of business. There is also a regulation, which is the ARA regulation, and in that ARA regulation, there is a form, special form, which is called form KT. So in that KT, you can usually like the percentages specified. So what I have seen is approximately, I think if I remember it correctly, it would be 3% of the sum assured, 3% of the reserves, and 0.03% of the sum at risk. I'm not sure about these percentages, but once again, ARA regulation is something that I'm going to cover at the latter part. So just to give an idea of how required capital is or the required solvency margin is kind of calculated in Indian scenario, it is based on factor based approach, right? So these are the factors: 3%, 0.03%. It can be whatever number, but these are the factors. So the summary from all of this, whatever is written in the first page, is there are two types of capital, which is the required capital, right? This is the capital required to support the business as it is written, and the available capital, which is the capital that is available over the asset. So I think that is also the available in life insurance company. The word capital can be used to mean either required capital or available capital. And insurance capital, available capital is the difference between the value of the asset and liabilities. The exact example that I gave. If the total value of the asset is 200 and total value of liabilities is 100, then 200 minus 100 would be the available capital, and that available capital consists of the required capital, right? In fact, in Indian scenario, there is a ratio that you have to maintain, which is 150% minimum at least. So the difference, so the ratio of required capital to available capital should be more than 150%. Right? So that's at least 150%. It can be more than that. However, the definition of what is exactly liability, which is something that we have also covered in investment regulation, is not clear. In Solvency 2, the liability can be best estimate liability, or the liability may also include the risk margin. So liability can be anything, right? In some cases, the liability can also consist of the solvency capital or the required capital. So for a proprietary company, the available capital is the measure of shareholder capital currently invested in the company. Or of course, we are, that's the capital share, that is the capital the shareholder has put into the company, and also the profit that it has gained. And excess of, although this can be more complex for with profit funds. Now for with profit fund, it is different. So with profit funds can be split into two parts. One is called the asset share and one is called the estate. So whatever belongs in the asset share is for the policyholder mainly, and some portion would be a very small portion, 90:10 would be for the shareholder. But if a policy, suppose in a year the asset share is, say, once again 100 rupees, but the company, because that it is at the discretion of the company how much bonus to give, the company decided to not to pay out that entire, like the asset share is not 100, the profit in the, the company can say distribute 100 rupees from that asset share, and the company decided to distribute only 90 rupees. So this 10 rupees would be part of the estate. So estate once again function as the estate, or also called FFA. This function as the capital for with profit fund. It supports the with profit fund, and we'll see more of that as we proceed. So in a 90:10 with profit fund, shareholder will be entitled to only 10%, which is something that we have just discussed. And unless this has previously been subject to some reattribution exercise, in such cases, company might successfully argue that the current generation of the with profit policy will have no real claim. So what has been called out here is, suppose the with profit fund is kind of getting closed. Like there is no new business been written, and the only few policyholders are left, and those policyholders have just taken out some policy. So whatever is present in the estate, the company can claim this entire thing belongs to the policyholder, because whatever has contributed to the building of the estate, this generation of policyholder, because they are new policyholder, they have not contributed much to that. So the entire capital should go to the shareholder. That is one way of putting at it, and that is why I mentioned in my investment, ALSM video, that with profit policies are the toughest that I've seen in life insurance. That's because there is a lot of discretion involved. There is a lot of judgment that is involved. So that's why with profit policies are difficult to understand. Now, within a mutual insurance company, there is no shareholder. It's wholly owned by the policyholder. Theoretically, the company belongs to the policyholders. That's what I mentioned. Available capital is more likely to be regarded as capital required to support the corporate entity. Right? Although the entire company belongs to the policyholder, there is some capital that is kept just to keep the business running. Right? So these are the three types of capital that is part of the required capital. Now, the entire discussion here would be on the required capital, because that is the difficult portion. Like the different companies would have different thing, and that is where all the actual judgment and actual calculation come into picture. Otherwise, available capital is very easy to determine. Once you have a fixed definition of liability, then available capital is your asset minus liability. Right? There is nothing much in there. However, for the with profit fund, the available capital would be the estate, right? And there might be some complications because of the judgment that is involved, like how much of the estate to distribute, whether to keep on increasing the estate. uh, for example, in the bad situation, when the investment market is bad, some portion of the estate can be used to smooth the investment return, so there the capital would be used. So for with profit fund, the available capital might have some implication, but otherwise it is very simple to understand. The economic capital also, these days you will also probably have heard about risk-based capital, which is the same concept, economic capital. So it is based on the risk appetite and risk profile. A regulatory capital, once again, the regulator is kind of interested in the policyholder protection. So this is where the prudence picture comes in. Regulatory capital, rating agency capital, some degree of capital has to be maintained so that it obtain a good credit rating. So that if it issues bond, it might be rated as AAA or BB. That is what has been called out here. So these are the different types of required capital, right? Remember this. These are the required capital. Now, all three approaches consider policyholder protection to some extent, of course, and there is a link between the ability to meet the policyholder claims as the fall due, broader risk appetite to the company, the relationship between companies, risk appetite, capital management is discussed in section 5. So obviously, whenever there is capital is always like high capital would be required when there is high risk, right? You cannot take high risk with less capital, right? So capital and risk management are very closely integrated, and also the ALSM is also very closely integrated with the risk capital. The moment your liability surpasses your asset, the risk increases, higher capital will be required, right? So all these are kind of interconnected, integrated, etc. So moving on to the risk capital, or also the economic capital, the capital which is required to cover day-to-day risk to which a company is exposed to, and this would be the market risk, credit risk, insurance risk, operational risk, liquidity risk, group risk. So basically, if you are going to shock each of this risk, suppose you are thinking that your mortality, because of the COVID situation, the mortality rate can go up, or the morbidity rate can grow up by say 20%. So I mean, you shock by 20% your current rate, and that is the stressed capital, right? And then you have the normal mortality capital. The difference between that will give you the risk capital. So in this way, you can calculate all the capital, and then you can combine all those capital, take some diversification benefit, which is a thing that we will cover in the Solvency 2. How do we calculate economic capital? So you shock for every of these assumptions, like market risk, credit risk, insurance. Insurance is a multiple other parameters, right? Mortality, persistency, or lapse, or expenses, etc. So shock each of this parameter, and then you take the capital, which is the stressed capital, take out the difference with the normal capital, and that's how you obtain the risk capital. Like for that risk, what is the capital that is required? So working capital, which is kind of required to support the ongoing business strategy. And in my LSM video, I maintain something called range cushion. So that same concept is applied here. Why is the working capital required? To fund new business, obviously, to fund overheads and development cost for organic expansion, like when you are acquiring new software, new hardware, etc. Acquire other companies, the cost of regulatory fines. This was the R part of the range cushion. Restriction on a product design, cap on charges, market condition, low negative interest. As I mentioned, if the liability surpasses your asset, your risk increases, you require more capital. Improving annuity and longevity implication. So this is a risk for improving annuity longevity is a risk for annuity products. As the risk increases, you require more capital for treating customer fairly. Now, if you are not treating customer fairly, there might be regulatory implication, and you require capital for that. Increasing competition, obviously, like this is kind of related to the first point here, acquiring companies or block of business. So all these are points, changing distribution patterns, which are for which the working capital would be required for. That is for the normal day-to-day running of business. So how increasing competition from fund management groups accentuate to the risk of the capital? That is the question. Increased competition might put pressure on the life insurance companies, changing their charging structure to be more attractive to the consumers. They're likely to be lower front-end charges, resulting in capital-intensive products. Obviously, so you are forced to kind of reduce your charges just to compete, and that's why, because you are reducing the charges, there would be less profit, and because of less profit, the capital the capital increase in capital would be much less, and you might require more capital to write such product, because initially there might be strain. So that's what has been called out here. Company that's following the Solvency II or similar regimes are now required to look at all the risk which the company is exposed to, which is part of ORSA. That's why I mentioned that how do we calculate the risk-based capital or solvency capital? We will cover that in Solvency II, but I just gave the brief of that, right? Like you shock one and calculate. So I just gave him the brief. So reason for projecting solvency. This is a very important portion. It has come in II question once, and so we need to remember this. First of all, for anything related to solvency would be related to risk, right? So the first point should be from risk. So you need to understand how the risk profile of the company is evolving, right? So that is kind of that is normal for us to think. Solvency projection will also impact the key business strategy. So depending on your business strategy, how much risk you are incorporating, like for example, a derivative strategy in which you are taking more risk, so then that can impact your capital. For with profit funds that are closed or in decline, solvency position important in preparing the runoff of the fund. This is a off point. I mean, I would not have thought of this point had I not remembered this entire thing. So for funds which are in decline, you need the solvency projection to kind of understand how it is getting run off. I think simple to understand, but it's difficult to remember. Solvency projection can be used to estimate the pattern of capital release. Yeah, of course, when you have more capital, you might be releasing more capital, or especially for the with profit fund, you have more estate, you might be paying some one-time bonus or something like that. So solvency projection can be used to estimate the pattern of capital release. The information can be used to assess whether the company is achieving a suitable return on capital. Obviously, so if you are started with 100 rupees and then because of higher profit that 100 become 1000, then you know that okay, we are going somewhere, we are getting a good value on the capital. Shareholder will be happy. The solvency projection may also be a standard requirement. Yeah, of course, it is required for the calculation of risk margin in Solvency 2. It is also required for the calculation of SCR. I think same thing has been told here. Solvency projection required in Solvency 2. Projection of solvency capital is required for determination of risk margin, as I mentioned. And solvency and may also form the part of solvency capital. I mentioned both of this. Right? So more broadly, such projection may play a role in successful risk measurement and risk management strategy. It can be used with reverse stress testing. So you start from a point, you know the output, and you want to come back to what could have caused that output. So that is the reverse stress testing. So this is something that we need to memorize, and thinking and the background that it is related to the risk. So anything related to solvency has to be related to the risk. So how the risk structure is evolving, and how how the return on capital is forming, and how it is impacting the with profit policy. So these are some things that we have to remember. So moving on, sources of capital. Obviously, for proprietary company, you can raise share, right? You can raise share. So that's what is kind of you can. So additional amount subsequently subscribed by shareholders or invested to subordinated loan stock. Now, what is subordinated loan stock? We'll consider just after few pages. And you all already know about the issue of shares. Like these days, there are too many startups which are coming to the market and they are raising share. So that's what we called out here. Profits being retained in the company. So the profits that is being retained is going to the. So I mean, in financial statement, there are two major financial statements. One is P&L. The outcome is either profit or loss there, which is for the period, and another is balance sheet, which is for a particular date. Now, balance sheet has asset, equity, and liability. So in the P&L, whatever profit you make, that profit is going to the equity section, which is the capital section. So basically, the more profit you make, the more your capital will increase. The more loss you will make, the more less your capital, the capital will reduce. So that's the overall concept. Consistent under distribution of surplus with the past generation, which is a concept that we have already covered. That with profit has two components: asset share and estate. And if you are not distributing the profit that is arising in the asset share, then you are going to then you are going to have some extra money, and that extra money would be put in the estate, right? So the estate would kind of use to support the asset share whenever it's required. Something, for example, if in a particular year the surplus distributed was 100, the same example, and it was distributable in the ratio 90:10, shareholder capital in the fund might theoretically be augmented by 4 if only 6 is distributed. So instead of distributing 4, instead of distributing 10, only 6 was distributed to the shareholder and 4 was retained, right? This retained 4 would go into the estate. However, if you are also retaining 80, like instead of giving 90 to the policyholder, if you are only giving 80, then what would happen to the 90 is subject matter of debate, and there is a lot of judgment that is to go there. This 90, ideally this 10 would also go into the estate, but there is a lot of discretion. It happen like what goes in the overall industry, what has been the company practice, that would form a structure, or that would give a structure to this thing. So I mean, same thing has been written. If the policyholder might have been given, it have left, then the reasonable expectation are presumably met, and the shareholder may argue that they are entitled to it full. The same example that I gave, that the generation of the policyholder who are new, and the policyholder, the estate has been brought brought to its current size by the previous policyholder. So the shareholder might argue that they would get the entire capital, because the current generation of policyholder is not kind of they have not contributed to the building of the estate. However, the opposing argument is that money represents surplus that should have been given to the policyholder because it's a participating policy. So any surplus should go more to the policyholder, because the policyholder is sharing, participating in that policy. So that's why it should go to the policyholder. So that's why there is a judgment involved, and that's why with profit policies are difficult. There are a lot of judgment that is involved. So the amount of available capital may have been depleted because of distribution of capital to the shareholders, dividends. Obviously, if you have distributed more of your estate, then that would be depleted. Losses incurred from without profit business. Once again, the P&L, in the P&L, the losses are incurred and it is hitting your equity. Consistent over distribution of surplus in respect of past generation with profit policyholder. So this and 2 points are same. You are distributing more dividends to the shareholders and to the policy. Whenever you are declaring dividends, you are paying both to the policyholder and to the shareholder. So these 2 points are same, and this is the P&L point, right? So in a proprietary company with profit business, in UK, is commonly written in a 90:10 front, which is the same as in it is same thing has happened in Canada. Same thing happens in India. So same structure. So under the 90:10 structure, shareholders are entitled to 1/9 of the cost of the bonus. Now, why is this called cost of bonus, right? And here also you will see the surplus on the conventional with profit business will normally be split in some set proportion, 90% to the policyholder and 10% to the shareholder. And so at one place they are saying that surplus is split into 90:10, which is kind of like making sense to us if anyone has studied with profit policies in ST2 or CD5. I think it is called CM1 now. So that is making sense that the profit is kind of getting distributed 90%, 10%. But this is a new term, right? Shareholders are entitled to 1/9 of the cost of bonus. Now, why is it called cost of bonus? Because if you don't declare bonus, there is no cost associated with it. So whenever you are declaring bonus, it is a cost to the asset share, because you are taking some portion of it and giving it to the policyholder. Right? And whenever you are giving it to the policyholder, the shareholder will also have to be paid. So whenever you are declaring bonus, it is a cost to the asset share, because you can think of the asset share as an individual, right? If the asset share is an individual, then the asset share is paying some money at his discretion. Asset share is not required to do so, while the asset share is kind of generous enough to give some money, right? Maybe because of competitive reason or something, but asset share is giving that money. and because of that there is a cost. That is a cost to the asset share, right? And that's why, because the participating policies are written from the context of the policyholder, first of all the policyholder will pay, so that 90 rupees would be paid to the policyholder. That would be considered as a cost of bonus, and the shareholder will get only 10 rupees. So 1/9 of that cost of bonus will go to the shareholder. So both this thing are same when it is written on when it is kind of defined in context of the surplus. It will be 90% of the to the policyholder, 10% to the shareholder. But you'll also hear this term that is just 1/9 of the cost of bonus. Both these are the same thing, and this is more prevalent. Like people will probably use this. These are used in the regulation as well. 1/9 of the cost of bonus will go to the guidance note 6, which is the with profit guidance note, and there you will see this term cost of bonus. So inherited estate is broadly the part of with profit fund over and above that is made to that is required to meet the realistic liability. So the inherited estate can be taken as the parallel of the surplus, the free asset basically, that is kind of present in the non-participating fund. So once again, going back to our previous example, your asset is 200 rupees, your liability is 100 rupees. So 200 minus 100 is your available capital. Out of that 100, say by whatever means, by factor method or by economic capital method, or but whatever method, you have understood that say 75 would be your required capital, right? 75 is the required capital, then the remaining 25 would be free asset, free capital. So that parallel, and in this is a with profit fund, so every profit, like 100% of the profit belong to the shareholder. But in a participating fund, there is no concept of that free capital or free asset. So you can kind of relate that free asset as the estate, that whatever is kind of extra that is flowing into the estate, and it is not required to back any liability. So it is free. You can invest that 25 rupees in equity as well. And although we'll not do that because it's too risky, but we can do that. So if the estate will grow significantly higher, the more it is growing, the more it can support the asset share. So we're given the long history of the with many profit funds and lack of historical data, it may be difficult to determine the source of inherited estate. Now, once again, whatever is present in the estate, its distribution has not been confirmed to the policyholder or the shareholder. Whatever present in the asset share, we know it will be distributed 90:10. But whatever is present in the estate, we don't know how it will be distributed. And there is a lot of challenges, like nobody can gauge like this 10 rupees in estate is belongs to the policyholder. There is no way we can determine that, especially after a duration. So that's what has been written here. And that's why the rules and the procedures around the intent and management of any inherited estate potential issues together with the target size in relation to the company's current business should be made available to the policyholders in any customer facing literature. So it has to be documented, and it has to be like whatever the practice the company is following, that has to be kind of communicated to the policyholder, maybe during the time of sales only. So the use to which the inherited estate can put would be undergoing much debate in the industry, aiding investment flexibility just to support the asset share, investment flexibility, helping to meet regulatory capital requirements. Once again, supporting the asset share, paying tax incurred by the fund on distribution to the shareholders. But there is a lot of criticism in this, like because you are kind of helping the shareholders, right? And covering overruns on the existing asset. Once again, overrun is related to the expenses. So you have loaded some expenses and you have got more than that, and that is what is being called out here, and help to smooth flexibility. So you see all this point, apart from this third point, the tax incurred, these are kind of used to support the asset share, investment flexibility, meeting regulatory capital components, meeting the overrun, providing smoothing facilities. All these are kind of supporting the asset share. See, the UK Select Committee criticized the use by some insurers for the inherited estate to pay the tax. I told you there is some controversy there on shareholder transfer and pay mis-selling compensation. The UK Independent Customer Body, which also raised concern regarding the effect of the competition and the use of inherited estate to subsidize new business. So these are UK specific thing, but normally you will not see, like especially in Indian scenario, that there might be like, unless it is specifically written or given as the practice, tax incurred by the fund on the share, the estate would not be used to do that. It is simply used for the remaining 4 points. So proprietary companies would notionally at least view some of the innate estate to be given to the shareholders, obviously, and however, since it provides additional security to the policyholders and permits company greater investment freedom, policyholders may also expect expectation that capital support by the innate estate will continue, right? So to be available to the with profit fund. So provided the local regulator is satisfied that the interest of the existing policyholders are not being harmed, more recently companies allowed to transfer or at least a earmark a part of their innate estate to the shareholder. So as I mentioned, there is a continuous debate of which part of estate belong to shareholder, which part belong to policyholder. There is no like kind of indexing like this portion is of shareholder, this portion is of policyholder, and that's why there is a lot of judgment involved. That's why you can see that how difficult it is to manage the with-profit fund. There's a lot of judgment involved. I'll do something, someone else will do something else, and that's why profits are difficult. But nevertheless, we'll cover the entire with profit policies in our SA2 course in the next week. So in order to allow for the company to continue to smooth benefits without excessive reserves, I think same points are getting repeated. So let's move quickly. Depending on the terms on such instruments, part of all relevant capital may not be available for immediate transfer. Once again, the same points are getting repeated. Mutual companies, which is purely owned by the policyholder, any initial or exceptionally subsequent capital injection in the company, uh, the available capital, obviously any initial exceptionally subsequent or capital injection, whenever the shareholder or the not shareholder, whenever the policyholders are injecting some capital or the profit is coming. So in mutual company, any consistent under distribution of surplus from the past generation of with profit, same concept as estate. So same concept are getting kind of repeated. So let's move on. Most mutual life insurance companies operate on the basis that the available capital within the company does not belong to any particular generation of policyholder. It is there to support the company as an entity. So it is just supporting for the support of the company. And that is for the mutual insurance company. So I think these are talking about the same things. The available capital is referred to as the innate estate or sometimes the orphan asset of a mutual company. It is asset available capital is not referred to back any asset, right? So I mean this should be the free capital, not the available capital. Available capital is in the available capital there would be the required capital which will be inbuilt. So this should be the free asset. When a company needs all of its available capital to become an issue in recent years in the context of demutualization, again, provided that the interest of the existing generation of policyholders are adequately protected, it isn't possible that the new shareholders to benefit at least indirectly from the available capital. Once again, the generation concept, and we have already gone through it in much detail. It is controversial whether demutualizing mutuals should allow shareholders to benefit directly from the estate. So, a mutual company being overtaken or being being kind of I mean captured or being kind of acquired by a shareholding company. So for that, will there would be and the shareholders are getting benefit from that, but the shareholders have not put in any money there. That might be considered as weak claim, right? Policyholders may have weak claim, current policyholders, but the shareholders have no claim at all, right? But once again, the shareholder might also reasonably benefit because they are providing some sense of security, right? So that might also be a logic that shareholders are, if something happens, then the shareholder is required to inject fund. So there is a sense of security. That's why that they might, require some return. So that's why you see that there is no clear answer here, right? It has to be based on the judgment, and that's how the company will function. Whether company it's all the as free asset is also an issue for the company that are kind of not considering a demutualization. For example, company with asset equal to 150% of the aggregate asset share might consider 50% of the margin was not needed to engage in any degree of smoothing. So once again, I think they're talking about the same thing, smoothing capitals. We have already gone through this. Why the company's expansion or dilute is free estate? Obviously, you are using your estate to kind of capture, kind of capture any software or anything. Free estate will dilute simply because after the expansion, both the assets and liabilities will be bigger. Right? Say example, 50% of the asset may become 25% of the asset. Okay, an effect will be permanent unless something happened to reverse it. So this is a portion of the chapter where they have kind of repeated the same points, and we have already covered those points. We'll try to move through it quickly, and we'll only consider the bold points, like which are the important points. So assessing available capital, we know the definition of the available capital once again, so I'm not going to repeat it. So the market value of now, obviously asset, so we require the market value of the asset, which can be easily observed, and that's what has been told here. However, for liability, we require the market consistent value of liability or the fair value of liability, which we have already covered in the LSM regulation, not regulation, LSM chapter. So you can, I mean, I hope that you remember that the difference between the market value of asset liabilities would be difference between the market value of asset and the liabilities assessed on this basis, like which is the like market consistent basis, would be called the realistic capital, right? Or more specifically, it is the realistic available capital. It represents the available capital, but it's the realistic, right? In a market consistent valuation, liability cash flows are in theory which are in line with the traded assets, and they close the most closely resemble. So this is based on the principle of financial arbitrage. So what happens, suppose you have a liability, and that liability can be replicated by any asset or a combination of asset. So you will say that the price of that asset will be same as the price of the liability, because if that is not true, then there would be arbitrage opportunity. So one will sell that asset and one will probably buy that liability, or do the reverse, like both two financial securities having similar cash flows cannot have different price, right? Otherwise you will short one and you will buy one, and then there will be an arbitrage and will make arbitrage profit. So from the principle of our financial arbitrage, that both these securities will have same price. So if a liability is closely resembled by an asset, so you'll get the price of that liability. That would be the price that which the assets are currently trading. But in life insurance, the liabilities are never closely resembled by assets. So we require estimation and assumptions to kind of determine the liabilities. So fixed liability due in 10 years will be valued in line with the 10-year zero coupon bond, and an embedded financial option in the line with market price of the similar option. So that's exactly what I mentioned, financial arbitrage. So for cash flows on no traded price, which is the case, market consistent valuation employ a combination of option pricing technique and interpolation or extrapolation between and from the prices that do exist to arrive at a value. Yeah, so you can use several methods. Normally, the method that we use, the prospective valuation of reserve, right? So that is what we use. Like this is a very difficult language that has been written here. Combination of option pricing techniques and interpolation of extrapolation of between prices. I think is just. I mean, these are all the blah blah language that is written to confuse people. So moving on, risk neutral valuation. We once again know what is the difference between risk neutral and real world. Risk neutral is the backward looking, right? So risk neutral is required to come up with the fair value. The use of market consistent techniques make sure market and credit risk, the risk cash flows will vary with interest rates, stock market movements, volatilities, credit spread, etc. Otherwise known as non-diversible systemic risks are appropriately allowed for within the market value of liabilities. So yeah, so that's, I mean, when you are using the market consistent technique, you have to kind of ensure that whatever risk that asset is, had the liability be an asset which would be traded in market. So these are the risks that that asset will be facing, and those are incorporated in the value of the liabilities, right? And that's why we have to kind of like the different estimations. Then we do the stochastic run and etc. So that this is where it comes from. And as I mentioned, mortality can also be stochastically projected, but we don't do that. Normally, we do it for financial variables. Insurance cash flows are subject to non-market risks such as variation, mortality, or lapse. Right? This is for the financial part, right? For example, if your liability is linked to an index, so for that portion, you require like those credit spread or default will be kind of incorporated in that liability, and you have to kind of incorporate those. So the appropriate allowance for this risk would be estimation of market values of liabilities, a complex area, and consideration need to be taken to the distribution of loss from such risk. However, economic theory includes the appropriate starting point for allowing non-market risk to be is a set of best estimate assumption. So instead of writing say all these blah blah things, I think what they could have written to make it much simpler is that for like financial or economic variables, you require stochastic models or distributions, and for non-financial variables, you require best estimate assumption. just keeping it simple. But I know this chapter is kind of written in such a manner that it will appear very difficult, and it is like people will take time to understand this chapter. It's not that complicated. It's just too many words, wordy chapter. So company with writing with profit business will need to include dynamic approaches to setting bonus rate, bearing in mind that company will treat customers fairly, right? These are part of the principle PPFM. So PPFM has like PPFM has principles and practices. Principles are kind of enduring statement that will not change very quickly. Practices can change, like practices can change. So the practices, this whatever you are kind of doing in the with profit fund, that has to be kind of written in the PPFM. So the realistic capital is the best measure of available capital for both the policyholder and the shareholder. Right? From a policyholder perspective, its calculation captures the value of the net asset available to meet the policyholder claims and include a realistic value of existing liabilities. In addition, realistic capital captures the interaction between asset and liability values, and these values, and between these values, the movements in the market distribution of the realistic capital provide the best measure of the policyholder exposure to downside risk. Because you know that this is realistic, so I mean, whatever happens in the market will be reflected there. And requiring the policyholder claims are met with some probability is essentially same as requiring the realistic capital is positive with some probability. So yeah, almost the same thing, right? Because the realistic capital is the difference between the asset and liability, so it means the same thing. Realistic capital is also a good measure from shareholder perspective. It can be used to define shareholder capital. Shareholder is only interested in the profit, right? So realistic capital will give them a better realistic estimate of the profit, and that's why it is more important. For policyholder, they might be they're interested in the prudence, but shareholder, they are only interested in the profit. So yes, realistic capital is more suitable for the shareholder from that regard. Assessing ongoing solvency, the life requirements for a life insurance company capital requirements cannot be assessed adequately by simply considering the current value of liabilities and assets to meet them, because there are few liabilities, a few risks that will happen in future, right? The ORSA, the very thing that we have mentioned about the ORSA. So that's why those risks has to be factored into the model. So the life companies operating in sometimes volatile environment, typically in relation to the market risk element, as I mentioned, something can happen in future, like the current market scenario. This market is crashing, so anything can happen. People who have, or the insurance company who kind of invest in equities, their portfolio is going down. So just by considering whether they have asset and liability sufficient just at this point of time will not be sufficient. We have to meet the liabilities in future, because in insurance company, you sell a product, you get a premium which is partial, but you might have to pay the liability at any point of time. The contingent event happens. So that's why future, what happens in the future is very important. In addition, the company will need to fund the ongoing business strategy. Of course, if there is a new acquisition, new software, etc., this requires information on the projected solvency. So we have all seen the reasons for the projected solvency, that is the portion that I told that you have to memorize this, right? So that is kind of assessing, once again kind of repeated here. Once again, a chapter which can be probably finished in 10 pages has been raised to maybe 20-25 pages just by making it more wordy. So I think we have gone through all of this. So this projection are not just to assess the probability of insolvency. For major with profit companies, the probability would generally be small. This is because in short term, the HCR would protect the company against most changes in investment condition. In the longer term, the company has a scope to cutting bonus or to absorb the effect of poor experience. Also, in extreme circumstances, more drastic than more normal can be justified. The concepts of treating customers fairly and meeting policyholder reasonable expectations should be considered. So I think, yeah, these are very simple, normal points. So economic capital is the internal assessment and based on the risk, allowing for the risk. This is very important, right? Economic capital always consider the risk. That's why it is an internal assessment, because different company might have different exposure to risk. So it can be done using stochastic model. It can be done using stress test. So stochastic model is usually used when there is a probability distribution. We have already talked about stochastic model in much detail. Stress test is used when there is no mathematical model, right? So you can apply some stress and see what is happening to the capital. So I think we'll go through guidance note 22 tomorrow, and that would give a better idea of how stochastic modeling happens. So because you are kind of here, you are projecting the solvency, you are using the real world economic scenarios, right? In market consistent value of liability, you are trying to find the value of the liability. So there you are using risk neutral scenarios. But wherever you are kind of trying to see what happens in the future, when you are forward looking, you are going to use the real world scenarios. So that's why you are using real world economic scenarios. Stress test when the distribution of particular risk is less clear. That's what I mentioned. When the mathematical distribution is not that clear, you are going to use this. Right? The impact of interdependencies between the various risks need to be assessed regardless of the calculation approach. One important factor is the time horizon over which the company should calculate the economic capital requirements. Currently, some companies consider 1 year period. Like if the company has sufficient capital to withstand any event in 99.98% of the cases. Right. So that's this one is, which is the VAR concept, value at risk concept. While others look at the full run of input. So this is a more prudent approach. This is a more better approach, but it will take a lot of time and the company might need to keep more capital. Also, the condition changes every year. So most of the company uses this VAR approach with time period of 1 year. And there is no single correct answer to the choice of horizon. Obviously, the longer your horizon is, the better it is, but it can change also very quickly. Things change. So 1 year you might require higher capital, next year you might not require that. So it probably is better to go through 1 year duration, 1 year period, and then take it off as you approach the end of the year. So risk of the companies are exposed to can be managed to capital market. It makes sure to use short time horizon on the assumption of this risk. Conversely, where the risk cannot be hedged, company want to look at economic capital requirements over a long period of time. So basically, if the risk are, capital market related risk, and if it can be hedged, financial risk basically, if it can be hedged, the company has, kind of argument to look at short time horizon. But if it cannot be hedged, then the company should look at longer time period. So prior to the introduction of Solvency 2, many of the large insurance companies were already using economic capital to help manage their business. Under Solvency 2, all companies falling in this regime must effectively now assess their risk capital portion to also. So risk-based capital has been mandated by the Solvency 2. So your capital, like in India, you are using the factor based. It has nothing to do with the risk. But most of these companies, and wherever you are using best estimate liability, because best estimate liability will give you negative reserve, right? Because in best estimate, in normal reserve, we have prudence involved, and because of the because of the involvement of prudence, whenever you are calculating the liability, so your value of the formula for the liability is like present value of benefits plus expense minus premium. But the liabilities are because these are prudent assumption. So at this stage, at the initial stage, those would be higher, like the benefits would be higher, expense would be higher than premium. But in best estimate, obviously you are writing the business on profitable basis. Otherwise, there is no sense. So there will be very few business which will be written on loss-making basis. So in best estimate basis, the bill would be negative, right? And the factor-based approach suggests that you are taking a percentage of the factor. So you cannot take a negative, like percentage of a negative amount. And then you are reducing your capital. That doesn't make any sense. So whenever you are moving into best estimate regime, as for example, IFRS 17, Solvency 2, where there is a best estimate capital that is being used, you have to kind of use the economic capital. That's the basis of it, right? Regulatory capital, once again, we have gone through this. Regulatory capital is the capital that regulator requires, right? Regulator requires that, and that might be prudent. Rating agency capital, we have gone through this once again. Same concept being repeated. Practical modeling, practical consideration, some form of solvency projection, particularly for the regulatory process, can raise practical difficulties, since in theory, probability of insolvency can require stochastic calculation. So you see, whenever there is a stochastic calculation, there might be some calculation related difficulty, right? You are using the real world scenario once again to calculate liability at any particular time. You also require stochastic simulation. For example, you are you're projecting with profit policies and for with profit liabilities. With profit liabilities has a bonus section that will depend on the investment condition, and when you project that, the bonus might be requiring a stochastic projection. So that is a nested calculation. Your liability requires stochastic calculation, and then your asset and investment factors also require stochastic calculation. So we have an inner model nested within the outer model, right? And that's what has been called out here. So some companies have developed techniques to simplify this calculation, or you can use closed form calculation, like Black-Scholes model. Right. So that is a closed form calculation. There is no need to kind of project everything. But yeah, I mean, this would obviously give you much better result, because that would give you result in much different scenarios, right? Number of different runs that are required for economic and solvency to internal models are also a present problem. And that's why to simplify things, you can use proxy models. Proxy models are term light models, right? That's why the simplification things comes into picture. You can use various statistical techniques such as polynomial or curve fitting, etc. So yeah, whatever you are doing, you are trying to determine your liability based on some assumptions. So you can use a curve like this, like these are the independent variables, and because depending on this variables, you are getting the value of liability. So you are using some sort of projection, some sort of assumption, some way to get to the liability, and you are trying to simplify. Instead of using so many mathematical or computing ability, you are trying to simplify it so that it would be easier. And yeah, and whenever we see the guidance note 22 to 22, which is based on the calculation for embedded derivative, I mean, this would all be probably more clear. But here, these are kind of like I think the overall concept is, I mean, is to understand that you are projecting something to calculate its value. So basically, you are projecting something to calculate what would be the value today by discounting, and yeah, and you have n number of method you can do that. You can use stochastic model, you can use a curve fitting formula, you can use some simulation, some scenario, etc, and that has been kind of mentioned here. So this is, I think this we have already considered. Whenever risk and capital, the relationship is very easy to understand, and risk and value. So if we want to know about risk and value, so risk also drives the shareholder value directly, as the market price of financial risk is the core driver of the shareholder return. So whatever the, like as I mentioned, if your business strategy is good, if you are making good profit, then that profit would be added to the capital, that would give you higher return. So that would make value for the shareholder, right? But nothing that is, I mean, it is written that interaction with risk, capital, value are complex, but they're not, right? We know that when there is higher risk, higher capital, right? And if you are taking high, and if by taking lower risk, if you are generating higher profit, then that is adding value. So it's just the business strategy. Whatever business strategy you use, depending on that, you are getting some value. So moving on, method of managing capital position. Obviously, for a shareholder company, not for a mutual company, you can raise equity, right? And there is subordinate loan stock. Subordinate loan stock is something which is, so this is a kind of financial security in which the seniority of the claims matters. So that it is senior to the equity holder. That is the claim of the people who are holding subordinated loan stock would be senior, or would be more stronger than the equity shareholder when the company winds up. But it will be after the normal policy, or after the policyholders and the debtors, normal debtors. So that's why it is called subordinated loan stock. It is subordinate to the policyholder and the normal debtors, but it is ahead of the equity shareholders. So there is a regulation of IRDA on subordinate loan stock. In fact, in March 2022, there is a question on subordinate loan stock. So the basic point is regarding the seniority, like why is this called subordinated loan stock, right? And that's I mean, you can see this consideration should be made to where any debt ranks related to the shareholder. This is when if the company winds up, who will get the like benefit, who is going to be paid first, and that's the seniority, right? That is related to subordinate loan stock. Securitization, I think this is applicable for, once again, for regimes which are not taking credit of the future profit. Like insurance is a business in which your profit comes at the end of the contract, right? Your for example, in other business, say you're selling a chocolate, you are making it for 10 rupees, you are selling it for say 15 rupees, you make 5 rupees profit uh, when that the sale has happened, and that is the entire profit that you made. That is the transaction lasts for only that time. But in life insurance, the transaction lasts for 10 years, 20 years. So when you get a premium, some portion of profit has been realized in the premium, and then you get the profit over the period of time, right? The entire profit is not received when you sell the product, but there are ways you can get that. So you can sell that profit, right? You can create a financial instrument and sell that profit, and that will be contingent. So that will, because you are kind of selling a financial instrument, you will get some asset, right? You will get some money in that will increase the asset, but the payment would be contingent on the profit arising. If the profit doesn't arise, you will not pay, right? So this is the concept of securitization. So obviously we know whatever is the prudence, or whatever is the, if you are using best estimate liability, then the risk margin that would get released, right? If the expectation is as per like if the actual value is as per expectation, the risk margin will get released. That risk margin will be your profit. And if you are not, if you have not kind of consider the future profit, then you can use a securitization technique. So whenever this profit arises, you would be using this profit to pay to the person. However, if this profit does not arise, then you are not paying anything to the person. So it is contingent on the profit arising. And because it is contingent on the profit arising, it is not increasing your liability, right? Your liability will only increase when you are paying that. Like it will increase an expense, right? But you are but when you are initially securitizing, then your asset is increasing, and that would improve the P&L section, right? That would show that you have more capital. That is one of the technique that we have used. Similar thing we have studied in ST2, if one can recollect. Also financial reinsurance, same concept. However, both this concept, financial reinsurance, are not kind of relevant after Solvency 2, or wherever there is a best estimate thing that is going on, whichever regime that takes credit of the future profit. As for example, in IFRS 17, there is a concept called CSM. It takes credit of the future profit. So then financial reinsurance or securitization, these are same concept that would not be that relevant. So moving on, final point would be derivative. And the insurer can use, obviously we have seen the points on derivative. You can use derivatives to stabilize your balance sheet, to hedge it. It is actually used for hedging. Derivatives, the primary purpose for which derivative was kind of used was for hedging. And yeah, and that's how it can protect itself. For example, if the equity, if it has some investment in equity, it has purchased the equity put option, the market falls and it can exercise that put option, right? Same option is given here. It can use swaption. Swaption is the option to swap for like if you for interest rate at a future date. So, and traditionally insurers have used over the counter, but right now they can also use exchange related. Exchange related would be much more exchange traded option would be much more liquid, right? And those would have much lower risk as compared to the counterparty risk or the default risk that OTC derivative carries. However, it will also be more costly. And obviously, since we are doing this chapter after the asset liability management, the closer your asset and liability is matched, lower is the risk, lower is the capital requirement. So that's it. I think this was slightly wordy chapter. Probably this chapter could have been finished in much smaller pages, number of pages. However, thanks for watching. And as my last point is, if you are benefited by this video, please like and share and subscribe. And if you don't want to do that, that's fine. But if you have any feedback, just provide that feedback in the comment. And if you also don't want to do that, just ensure that you help at least one person in your life. Thank you, and see you in future videos.